Good evening, guys, and welcome back to the channel. Today we're going to talk a little bit about Warren Buffett and what he likes to refer to as rule number one. So we're going to start with this rule number one, then I'm going to talk to you about how to interpret it, and then I'm going to give you two examples. One which you are probably familiar with is dollar cost average, and then I'm going to give you another example that I think, well, maybe you don't know this yet. And finally, I'm going to show you an example of the Excel file that you can use, which I will be releasing in the next video when I go more in depth on the stop loss and the re-entry part. But let's start with rule number one. Rule number one, don't lose money. And then rule number two, don't forget rule number one. Warren Buffett is very famous for stating this, and yeah, obviously it makes a lot of sense. You shouldn't lose money, but I think this is one of the easiest thing to say, but harder to actually accomplish. In other words, easier said than done. So let's break this down and see how it's being interpreted, and then how maybe we should look at it. As always, please keep in mind that I am not a financial advisor. The content on this channel and on my website is intended for educational and entertainment purposes only. So the interpretation of rule number one, don't lose money. I wrote down three statements that you may be familiar with, that people will probably tell you if a stock is dropping or if they feel like something is not right. I think you could even say it like that. Like, don't sell in a downturn. Nobody ever went broke taking a profit, which is not really about losing money, but it's more like you can always sell when you make a profit. But regardless, I think it belongs here as well. And avoid realizing losses. And realizing losses just means selling a stock when you have a loss on it. Just wait for it to go back into a profit. Just be patient. That is something that many people believe as well. However, I don't think it's always the case that stocks will return to its previous numbers. It could be that it was overvalued to begin with, or it could be that just the whole industry is going through a rough time. So how can we be aware of this? But how can we protect ourselves from it? I think that's even a better way of putting it. And but I want to give you a few examples first. Let's start with TUI. TUI is a pretty famous company, and in 2017, as you can see here, it was around 20 euros per share. Right now it is trading around the 3 to 4 euros mark. Let's say it's 4 euros. That means it lost 80% value in the past 3 years, give or take. Like, I think it's even less than 3 years, 2.5 years. So how likely is it that from this point on, TUI is going to get a return and going to reach these previous levels? Sure, if it's only a temporary setback, then yeah, but you can see that this is not just the outbreak that is making it a drop, it is also something else. So how likely is it that it's going to return to this? And then the second question you should be asking yourself, if it is likely to return to this, will it be in a reasonable amount of time? So let's say this was 2 years, because it's pretty close to 2 years. Let's say it needs 5 to 6 years to return to the level. That means that if you had bought it here, you would need to wait 8 years to break even. And if you break even at that point, obviously the opportunity cost of having no cash gain in 8 years is pretty significant still. Obviously you wouldn't have realized the loss, but it would be pretty costly. And that is on the assumption that it's going to get back to the previous highs, which I don't think is a guarantee at all. Then we can look at two oil companies. Let's start with Range Resources, RRC. You see here that 5 years ago it was trading around the 45 US dollars, and here it was trading around let's say 43, 42, and right now it's trading at 6, and here it was even trading at around 5ish, I believe. So this means that it has dropped between 80 to 90% over the course of 5 years. How likely is it that it's going to return to this level? And if it does, how long will it take? So should you be waiting for that? That is also a really important question. And could it be avoided that we bought it at the highs and then we go low? We have a more stronger example, at least that's what I think, is Antero Resources. 5 years ago at 33 US dollars. I believe 7 years ago it was around the 50 US dollars. But let's stick to the 5 for now. And then we see that right now it's trading at the $3 mark. That means that it has dropped over 90%. That is insane, and it's going to be very hard to recover from that. If it does, how long will it take? And how likely is it that it's going to recover? All questions that should be asked, and just because, and the main point of this is you shouldn't just follow rule number 1 and think, well, I don't want to lose money, and as long as I have unrealized losses, I haven't lost any money, because that's pretty common to think like that, and I don't think it's wrong, but I do think you should be aware of the impact that unrealized losses can have on your portfolio. I have a final example, and this is a company that I own, and this is Criteo SA. This is a company that is doing ad targeting, or ad retargeting I should say, so it's an advertisement, and from like 6-7 years ago until let's say 2016 it was showing, or 2017 I should say, it was showing an incredible growth. Like I think the growth numbers were between 30 and 40% per year. So that was all calculated in the price. And all of a sudden they had a few setbacks. Like cookies weren't allowed anymore with re-ad targeting. And yeah, they were being questioned if they were not using private stuff. Let's say privacy issues, I should say, sorry. And it has dropped since they haven't been growing anymore. They've actually been reducing their revenue. So instead of increasing revenue, they've been reducing it. So all in all, it is going very bad for this company, and right now it's trading at a 10 euro mark, meaning that it, from this high it has dropped over 80% as well. And then you should maybe wonder, how likely is it that it is going to go back to these levels? I don't think it's that likely. I'm also fortunate enough that I didn't buy it at this, because I don't buy a lot of growth companies. But I may actually start considering buying growth companies with this new method that I figured out, but we'll get to that later. First, I want to show you just how impactful a unrealized loss can be. So if you just lose 5% of your portfolio, let's say you have invested 1,000 euros and you lose 5%, then you have a 950 euros left, and to make that back into 1,000, you will need a return of 5% and a little bit more, like 5.26%. That is a unknown recovery difference of 0.26, because our psychology might say, or the way our way of thinking is, okay, I lost 5%, now I need to make 5% back, because I lost 50 euros, I need to make 50 euros back. However, you have less money to make that 50 euros back, and that is why you have this difference. This difference increases over time. So let me give you, like, these are all examples and you can just see the unknown difference, but I want to start with the 50% loss. Let's say you have, again, 1,000 euros and you lose 50%. Then you have 500 euros left. If you want that to make that again into 1,000 euros, then you have 500. It needs to turn into 1,000. That means that you need to have 100% gain. And as you can see, the more you lose, the higher the percentage that you were going to need with that same amount of money that you will have left to break even. To even break even, like, we're not talking about a profit here. So that means that if you buy a company at 1,000 and let's say it's 0% loss, like it's even, and it dropped 80%, that means that with that same amount of money, you're going to need a 400% return in the future. That's tough. That's rough, I should even say. Like, that's going to be hard to accomplish, even if it's just a temporary setback. Like, you'd rather buy it at this price, right? And then if it goes even back to the previous levels, you would actually have a 400% return. Like, how would you ever not want that? But obviously it's very hard to time the market and stuff like that, so we shouldn't be thinking about that too much. But I do want you to realize that if you go below, let's say, 25%, the amount of return that you're going to need is going to increase in such a way that it's going to be very hard to recover from a loss like that. And I want to show you that with an example, because it's not really an example for that, but I just want to tell you as well that it is not just because a company has dropped significantly doesn't mean it's not going to drop even further. So even if you think, okay, a company has dropped 90%, but from this moment on it will recover, that doesn't have to be the case. Obviously, this example is not likely to happen in a short period of time. But if you're just going to hold a company and you're going to wait for it to recover, then you're going to be in a lot of trouble. So let's say you have a share price of $100. It drops 90%. That means that at that moment you have $10 worth of value. If you then keep holding it, or let's say somebody buys it at this price because they think, well, it's going to go back to the previous levels, and then it drops to $1, that same person has a loss of 90%. And then the second or the third person comes in and says, well, it was at $100, it's so likely to go back to that, or to even if it goes half or only a tenth, if it goes back to $10, I will make a profit of 900%, so that's worth it. And that person buys it at this price, and then it drops another time for 90%. And yeah, like I can keep going, but you'll get the point of this story, right? So like the bottom of any share price is zero. If a company goes bankrupt, it's nothing, it doesn't have any value. And that is something you should always keep in mind. And just because a share price is 10 cents, yeah, you can still lose all your money. You can still lose 90% of your money. So how do we make sure that if we invest in a high share price, how do we ensure that we're going to make a profit? One of the reasons that people really like is dollar cost average. Dollar cost average would basically mean, okay, well, I'm going to use the same example, by the way. I'm confident in this company, and if I was willing to buy it at $100, I'm going to be willing to buy it at $10. And if I was willing to buy it at $100 and I still don't think anything has changed in the company, then I'm going to buy it at $1, and so on, so on. So dollar cost average in this way downwards is just, okay, I bought a company and I want to reduce my average buying price, so I'm going to keep on buying more. In that way, you can actually get a very low share price just by doing that. So it's a very good method, and it is a method that is very broadly used, but it comes at a few requirements, I'd say. So these requirements are that you need certainty. And what do I mean with certainty? I'll get to the rest later. With certainty, I mean that you need to be confident enough to invest in this company. And you need to be confident that whatever is causing the share price to drop does not impact the company in which you viewed it. Like what you thought of it before, like your initial investment thesis, one might say. Then the second one is systematic approach. With a systematic approach, I mean that you cannot just, okay, and this is a mistake that I made as well, because I was like, okay, the share price is dropping of DGOC, I'm gonna buy more. But I don't think it should be approached that way. I think you should have a plan set aside. Okay, if it drops 20%, I'm gonna buy extra of this. If it drops 40%, I'm gonna buy even more. Like, you need to have a systematic approach, and you can't just think, okay, I'm just gonna buy it on the way down. I'm just gonna spend all the money that I have. That's not how dollar cost average works. Or well, it could work like that. I'm not gonna say it doesn't work like that, because I did it, and I don't think it was bad, but I think it would be better to have a systematic approach. I think I should tell it to you like that. One of the requirements of dollar cost average is that you have cash on the side, because you want to be able to buy it when it drops. So you have some opportunity cost because you're not fully invested in the market. And one of the benefits that comes with this is that you don't need to time the market. I think that's one is pretty obvious. It's not like, okay, I'm gonna guess when it's gonna drop until this level and then I'm gonna buy it. No, you're not timing the market, you're buying it, and when it drops X%, you're buying more, buying more, buying more. If it goes up, you have all the benefits. That's basically dollar cost average. Now let's go to the final one, or the second one as well, and this is a stop loss and re-entry method. And let me read this for you real quick. A stop loss is a way to avoid further losses by setting up a predetermined price at which you will sell the shares. A stop loss is commonly used in day trading. However, I now believe that it could be very beneficial to long-term value investors. So how would I see this stop loss? Like in general, a stop loss could be just, okay, I have a share and I'm just going to put 10% under the share price right now. If it drops below that, I'm done. Like I'm not risking anything more. That could very well be the case. I think that is a very non-emotional and a systematic approach to look at it. However, the problem with a stop loss is that you don't have a re-entry point, and I think you should have a method in place, and this will require a completely like a second video. I think you will need to have a method in place, a systematic approach on when you're going to re-enter the share that you were previously in. But let me just compare stop loss and re-entry to dollar cost average. It requires less certainty, and I will go through the other 4 again in a bit. What do I mean with less certainty? If you are not that sure about a company, let's say it's at $100 share price and you're investing in it and you're not that certain about it, you just have a stop loss at $90, like 10% drop, and you can actually be comfortable, okay, if it drops 10%, I'm going to lose it. If you are about to dollar cost average, you are actually more certain about the company because you think that at this price it's already attractively priced and you're just going to buy more below it. Slight difference. Doesn't mean that I think you should be less certain if you are investing in any company. I think you require a lot of confidence and certainty before you should make any investment. Again, this is a systematic approach. The benefit of this is that you don't necessarily need cash on the side to average your way down. Let me just put it like that. The bad side is that you require timing. The timing part is something that the re-entry should actually resolve. If you have a method in place that, let's say, okay, if it has dropped 50%, then from the price that I bought it, then I'm going to invest in it again. If it goes up higher, then I'm not going to invest in it anymore. You could have something like that. Obviously, that increases your chances of losing any gain on that investment. But you could also have something different in place. For example, okay, I'm going to wait until it is done dropping and I'm going to invest in it the moment it is 10% above its recent low. That is also a systematic approach to a re-entry. And it could mean that just because you had a stop loss at 10%, it hits it at 10%, and from that moment on it goes back up again. That, yeah, you basically lost 10% money, 10% of your money, and you basically have a worse price of when you got into it, but it does protect you from the downside. So that is something that you can think about. So how did I come up with this? Well, I didn't come up with it obviously because I got the idea from a book, and this book was from Joachim Clement, and it's a book called 7 Mistakes Every Investor Makes, and like he kind of convinced me why this would be a good method, but I want to focus on something else that doesn't really get discussed, and I also want to mention why I think this stop loss and re-entry method is not being mentioned in any value investor book. And that is because one of the benefits we have over hedge fund managers, and hedge fund managers are mostly the ones that write the books, is that we invest with thousands, not billions. It makes us very liquid, and with liquid I mean that we can just get in and out of position very quickly. However, that leaves us with the main issue of a stop loss, and that is when should we re-enter. And that is basically something that I'm going to be thinking about, and I'm going to make a new video shortly, because I've already given it some thought, and I think that the method that was partially proposed by Joachim Clement, I think that is a very good one. And I believe as individual investors we have this benefit. It makes us very liquid, just because we can just, any position we can just get it. If we want to sell it, we can sell it. It doesn't really matter. If you have billions, then you can't just sell it. You have to wait months for it. And every book that you've read has been promoted by someone who actually was investing with billions. And yeah, they cannot do this. They cannot have this. And I think if you read Margin of Safety, you will, from Seth Klarman, then you will know as well that one of the benefits that you have as individual investors is that you are liquid. So this is why I will be looking into this method more, and I may be implementing this over dollar cost average. I realize that is a bit late since we have just recently seen the drop, but I think even in a bull market or like an upwards market for the next 10 years, if that is what we're going to see, then I think it would still be very good to implement a stop loss and re-entry level. So I also worked on an Excel file to show you the difference between, well, basically dollar cost average, the stop loss and re-entry, and you can also use the file to see what happens if you don't use any of these methods. So I will share this file with you, by the way. I will share it on my website, and I will just explain the Excel file more often or more clearly when I actually have it finished. But we have a point where you have data input, and you're just going to fill in the details that you want to use for your equation. Then we will see the results in a DCA method, so the dollar cost average, and I actually implemented a 5-year compound annual growth rate to go with that. And with the same details, it will also show you what happened if you were to use a stop loss and re-entry method. Keep in mind that at this point, if you just go to the data input real quick, that we use a stop loss at 10% and a re-entry at 50%. Obviously, if this happens, you are pretty lucky if you were using the stop loss and re-entry method. Like, I'm not gonna lie. But you can even use this part and you can say, okay, well, I'm gonna stop loss at -10 and I'm gonna re-entry at 0. So I'm gonna entry again after the stock price has gained 10% from its last low. Then you can still see the difference in the compound annual growth rates, and you see that maybe, but I'm gonna leave that up to you, that maybe it would be better even to just take that loss and go again, on the presumption that it could also be the case that you're going to lose this amount of money. So it's basically a different look or a different way of looking at the risk and reward from any investment. So I will share this file with you. I will also explain it. I will also go through a few things once I've done it, and I will just basically make a video on the stop loss and re-entry method. Now, you may be wondering, well, why on earth did you make this video on the presumption that rule number 1 is don't lose money? And that is the reason for that is that people think, and I was one of them as well, that as long as you don't sell, you're not losing any money. However, I think if we want to implement a systematic approach and take emotion out of the equation, we are gonna need to realize losses in order for us to don't lose money. And I know that it's gonna sound incredibly backwards, but that is my thesis right now, and I hope that once you will have my Excel file, that you will realize that, hey, maybe there is something to this, and maybe I can learn something from day traders and their systematic approaches to investing, and maybe I can actually protect my downside with that even better than I'm already doing now. And that's basically what I wanted to teach you or tell you with this video. So I hope the next video will be even more convincing of that, because I just want you to become a better investor. So that's it for today. I hope you guys enjoy it. If you like this video, please leave a like. I expect this Excel file to be ready and the video to be ready this weekend as well. So stay tuned for that one. And for now, I wish you guys a very nice evening.